In this video, I'm going to show you a very powerful entry technique which is accurate over 85% of the time when used to trade euro-dollar. This video is a follow-on from a previous video in which I showed you how to use what Larry Williams calls smash day setups. The entry technique in this video differs ever so slightly from the previous in the way that I filter the smash days, and in this video I'm going to give you 4 different exit techniques just to show how reliable these smash day patterns can be. I'm genuinely surprised and impressed with how well this entry technique works. Firstly, I'm going to show you what a smash day looks like and how to use them to enter trades. And then I'll show you the best way to filter the trades because, and I'll show you this later, we don't really want to be taking every single smash day which comes along. So here's what a smash day setup looks like. Obviously, we're going to be using a daily chart. And all the results I'm showing you are for euro-dollar. Now, I've actually marked out this smash day here, and this is a buy setup. So this is a setup to go long. I've also got a setup here, which is a setup to go short for a smash day. But let's concentrate on this long trade. They're very easy to spot. All we're looking for is the close. Now, I've actually marked the closes just with these red dots. We just want to see the close of the bar less than the low of the previous bar, and that's our setup for the smash day. We don't take the trade yet. We take the trade the next day only if the high of the smash day is broken to the upside. So the minute we see this, we then set a buy stop order at the high of the smash day at that level there. Then if the next day actually starts to rally and breaks through that, then that will get us in the trade. Quite often you'll see closes which are less than the previous low, and then this bar here will just keep going down. We'll continue into a downtrend. But when we see prices stopping, reversing and breaking above the high of that smash day, then that's the market telling us that it's probably like a turning point in the trend and a good time to get long. And of course the opposite is for short sale setups. This one here, the close was above the high of the previous bar. Now on the next bar we would set a sell short stop order at the low of this smash day. Okay, so if on the next bar prices didn't continue to go up but they started to go down and they broke through the low of the smash day, then that would get us in the trade. If we were already in the long trade, it would get us out of the long trade and then into a new short sell trade. Okay, now I'm going to show you the results of taking every single smash day when we go to the computer. However, we don't want to take every single smash day. We can vastly improve on it by adding in a little filter. Now, in Larry's book, where I picked up the idea from smash days, he actually said that quite often the low of the smash day will actually take out the previous 3 to 8 bars lows as well. Now, I haven't used the lows, I've actually used the closes because I think they're more significant. So what I'm using for a filter is I'm saying that only take the long trade if the close of the smash day is the lowest close over the past, let's say 3 days. So if we're using 3 days, we look at the low here and then we count back 3 bars. 1, 2, 3. These are all the closes marked with the red dots, and we know that the smash day close is the lowest over the last 3 bars. If we were saying only take the trade if the close is the lowest over the last 4 bars, so we count back 4 bars, 1, 2, 3, 4, actually no, because this close here is actually lower than our smash day close. So it hasn't taken out the close on that 4th day, so it's not the lowest over the last 4 bars. Now I don't know whether we're going to use 3 bars or 4 bars. We're going to test this, and I'll probably test it from 1 to 10. So when we talk about looking at the look back for that filter, that's what we're talking about. And once we've found what works best for the entries, then we're going to look at the 4 separate exits. The first one is going to be actually no exit at all, but it is an exit. It's going to be a simple stop and reverse. So the exit for a long trade would be an entry to a short trade. So we're always in the market. That's number 1. Then we're going to look at getting out of trades much faster, and we're going to use the first profitable close. So as soon as we see a close of the daily bar in profit, we get out the trade. Then we're going to look at an even more simple exit, and it's just going to be a simple X bar exit. So we might say exit after 5 bars in the trade, regardless of whether we're in profit or not, or exit after 10 bars, etc. And that will really give us an idea of how powerful the entry signal is. And then the last exit I want to show you is going to be a profit target based on the stop loss value. So if we're using a stop loss of 100 pips, then we might test a profit target between 0.5 and 5 times that stop loss value. So if we were using 3 times, then we'd use a profit target of 300 pips. And I can tell you now, with all of these exits, they all work. So let's go and have a look at the results on the computer. I'm using multi-charts to carry out this testing, and I've got data from Oanda from January 2010 through to December 2021. So firstly, let's look at the results of taking every single smash day which comes along with no exit, no stop loss, just a stop and reverse exit. So we're always in the market. Okay, so an exit from a long position is an entry to a short and vice versa. So it makes money, it makes quite a lot of money, net profit of $60,000. And by the way, I have actually included $60 round trip, or equivalent to 6 pips worth of trading costs for the testing that I've done. There's the equity curve, which is not the smoothest, but I've already told you we can improve on that by looking at that filter that we discussed over on the whiteboard. So I've run an optimization on that filter that we talked about, and I've got this input here called look back, and that's saying that we want to see the close is the lowest close over the last X days, and we've got 1 through to 10, and if it's a short trade it's the highest close over the past X days, or look back days. And looking at the results, number 1 is what we've just seen, which doesn't use a filter whatsoever. And then if we look down the net profit, we can clearly see that 8 is the best. Interestingly, like I said earlier, Larry did say in his book, when he was looking at taking out the lows and the highs, he did say between 3 and 8 days. So I'm happy to use 8 as our filter. So if I select 8, there's the equity curve, which is nicer, it's smoother, it's moving more in the right direction more consistently. We already know we're making raw profit at 81,000. Look at the total trade analysis. We have got less trades because now we're filtering trades. Huge average trade of almost $1,000 per trade. Very largest losing trade at almost $11,000. That's almost 1,100 pips because we haven't got a stop loss at the moment. So that's probably what we should look at next. So in the next workspace, I'm going to include a stop loss, and I'm going to use 250 pips. That's not particularly optimized, it's just from experience I know this kind of strategy on this market, 250 is a pretty good area to use for the stop loss. Now at the moment, the strategy doesn't use a particular exit, it just exits with an entry in the opposite direction. And it holds trades for quite a long time. But what if we want to get out quicker? Well, now we're going to use, including that 250 pip stop loss, what we're going to use for the exit is the first profitable close. So the minute we get into profit, we exit. Sometimes we're even exiting at the end of the day, which we actually got in the trade. In fact, look at these examples on the charts here. We get in the trade here, and then we've got a close which is profitable, and then we exit on the open of the next bar. So we're in these trades less than 24 hours, unless we're holding one over the weekend. Okay, same here. We're in the trade, we're in profit straight away, so we exit. So trades are much faster in duration. That's what the equity curve looks like, and that's quite nice, isn't it? Very consistent. We're making much less money, only almost 31,000, but that's because we're not holding the trades for very long. Look at the total trade analysis. We've got many more trades now. Percent profitable, just over 85%. It's very accurate, isn't it? Largest losing trade, there's our stop loss value, plus the $60 in trading costs, so just over $2,500 compared to that almost $11,000 largest losing trade before we used the stop loss. We still have an acceptable average trade size of $219, that's after costs, but dramatically smaller than that almost $1,000 average trade using no first profitable close exit. What we could do is we could include a day delay, and you've probably often seen me use a day delay with the first profitable close. So we might say we need to be in the trade for a minimum 3 days, and then we look to see if we're in profit or not. I'm not going to go into that now. We're going to move on to another exit, but that is something that we could definitely include, and I can tell you it would work. But instead of that, what I want to do next is look at a different exit, an even simpler exit, and it's exiting after X bars in the trade. So it might be 5 bars, 8 bars, 10 bars in the trade, regardless of whether we're in profit or not. But first, if you want to see more strategies like this, rule-based strategies, I've put together a 22-page PDF. I call it the Beat the Markets Strategy Guidebook. And in there, you'll find 3 more strategies, a little bit like this one. I'll leave the link in the description down below. And at the moment, you can get that absolutely free. So if you're interested in more, click on that after you've watched this video. So in this workspace, what I've done, I've run the X bar optimization. You can see the input here is my bar exit. So if it's 0, then what we're saying is we're going to get out the trade absolutely immediately. We're going to be in the trade less than 24 hours. And look at the net profit, that loses money. If we stay in the trade 1 bar, then we're still losing money. But then look, anything above 2 bars is progressively just gets more and more net profit as we go. Right up until, if I scroll down, I've gone from 0 to 30, and the highest is actually 22 bars, 23 bars. It's quite a stable area. So if we want absolute maximum net profit, we want to be getting out the trades after about 20 bars. But the point of that optimization, using that exit, was more to look at the reliability of the entry or the quality of the entry. And we can see that the entry obviously is really, really good, because anything above 2 bars, if you exit after anything above 2 bars, you're going to be in profit. If you want maximum profit, hold for about 20 bars. If you want to be trading more actively, then hold for less. Let's have a look at a couple of examples. So let's say we want to hold just for 5 bars. So you'll notice that we've got in the trade, and then we've got 1, 2, 3, 4, 5, then exit. Okay, in the trade, 1, 2, 3, 4, 5, then exit. Every trade is going to be the same duration. Okay, there's the equity curve, very nice. We already know the net profit values, we've just seen them in the optimization, but very consistent behavior. What about 10 bars? Let's adjust it from 5 to 10. Again, really, really nice equity curve. So we can see that the results are pretty consistent. Out of interest, let's do the, what was it, 22, I think that was the best value. And there's the equity curve, again, very nice, with the maximum net profit of $117. Now, the last exit that I want to show you is that profit target. And what I've done is I've done an optimization for my profit ratio, and I've gone from 0, so that's using no profit target whatsoever. That's just the stop and reverse with the 250 pip stop loss. And then I've gone from 0.5 through to 5. So if this was 1, that would mean we're going to set a profit target at 250 pips, okay, because that's what our stop loss was. If it's 2, then our profit target is 500 pips. However, we won't always be hitting the 500 pips. We might be exiting way before that, because we might get an entry to go in the other direction of the trade. So we're not always going to get the full profit. So looking at the net profit for these, this is no profit target whatsoever. And then if we move down, 0.5, it's not particularly good. We have got a higher percent profitable because we're cutting our trades a bit short. And then the values come up, and the best one here is 4.5. Now, most of those trades won't be hitting 4.5 times the 250 pip stop loss, because we'll be exiting because we'll be getting an entry into the other direction. Let's have a look at, for example, a 1-to-1. If I select 1-to-1, so that's setting us a 250 pip profit target. You can see here, look, we've hit our profit target. before entering a trade in the other direction. Another one here, short trade, profit target. If we look at the performance report, equity curve looks like that. Slightly flat recently, but still good. If we look at the actual trades, we can see first trade here, 2,470. That's pretty much our profit target. And we can see we've gone short and have hit our profit. Next one, we've bought, hit our profit. Okay, that's actually 269 pips. That's hit. Short, profit target, 247 pips. And these are all either hitting the stop loss, like this one here, or they're hitting our profit target. But we will get some. If I scroll down, here for example, we're in a long trade and we didn't hit our profit target because our exit was to go short, and we only made 94 pips because we had that entry signal to go short. Okay, but looking at that optimization report, pretty much every value worked with using the profit target. I don't think as well as some of the other exits. I don't generally like profit targets, but nonetheless, if that's the sort of exit you like, then it does work. Well, I think you'll agree that using smash days with that added filter on euro dollar gives us a very powerful entry technique. And I've shown you various working exits which you can use depending on how you like to trade. And you could even combine them. What you could do is you could split your position into half, and once you're in the trade, you could say, let's exit half the position on the first profitable close, leave the rest running until you get an entry to a trade in the opposite direction, then exit the rest of that and enter the new trade. It's up to you. Have a play around with the ideas that I've shown you. I hope you've enjoyed this video, and if you have, then please do me a favour and give the video a thumbs up. But that's about it for this one. So until next week, this is Jared Goodwin, and thank you.